Hey, welcome to the tip here at agendatruth.com, where the truth is our only agenda. So today we're going to talk about our wonderful banking system here in the United States. Yes, we love our bankers, especially in my hometown. It seems like the only types of businesses that we really have being built are churches and banks. I wonder if they go hand in hand. I don't know. Well, first off, we have to understand a couple of things. Debt is slavery. And our banking system here in the United States is set up, and it's a system that lives by creating slavery. So here's something your banker will not tell you. And first off, I'm going to put this out there. All you bankers out there, our toll-free number is 1-888-895-1008. So if I am incorrect in any of my theories here that we discussed, please feel free to give me a call, and I'll be happy to correct it on my next show. All right? Now, your banker will not tell you what you are about to learn here, because if he or she does, guess what? They will be out of a job. The truth is, the very foundation of our banking system sets upon a foundation of required borrowing and continuous growth of debt. Remember, debt is slavery. If borrowing stops and debt ceases to grow, then the system stops. Now, if you pull the foundation out from under a building, it will collapse. So, if the foundation of our banking system is pulled out from under it, it too will collapse. This is the reason our currency was removed from the gold standard and sound money was then transitioned into a fiat currency. A fiat currency which is just paper money with nothing but a promise, because the amount of money needing to be produced to support the system has far exceeded the ability to regulate its existence with gold. This will lead to inflation. Inflation is why your grocery, fuel, and energy prices are increasing. When the Federal Reserve tells you that the rate of inflation is 2.5% to 3%, that is a lie. They tell you that because in 1980, they changed the formula for calculating inflation by removing the cost of food and energy in the equation. Oh, that's some of that funny money. Well, we can't seem to decrease the rate of inflation, so let's just take the prices of these goods out. Oh, look! We're no longer at like 16 to 20% inflation. We're down to 3. Aren't you so proud of us? Woo! See, the real rate of inflation is really 16 to 20%. So while the Federal Reserve Chairman Mr. Bernanke likes to brag about the reduced cost of iPads and iPods and China-made TVs, we the people understand that we really should turn our cell phones off whenever we're on a show. But that's okay, so I'll just ignore that and I'll call that person back. So, you know those China-made TVs that I was talking about? Here, let me mute that. Apologize for my rudeness. Now, back to what I was saying. When the Federal Reserve Chairman likes to brag about reducing the cost of iPads and iPods and China-made TVs, we the people realize that we cannot eat our televisions for survival. Let me see here. Hang on. Doesn't work. I'm not going to be able to get that down, okay? And, our iPad has yet to transport us from point A to point B, and our iPod has not developed the ability to heat or cool our homes. Let me tell you something, people. I'm going to warn you right now, an economic collapse is on the horizon. I'm not a prophet. I can't see the future, but what I do is I study history, and I see what civilizations and people have done in the past and what happened to them. And when we are doing the exact same things that those civilizations did, why should we anticipate a different outcome? The definition of insanity is doing the same thing over and over and again and expecting a different outcome. I feel like our Federal Reserve Chairman in our country, well, they're insane. So, for all you bankers that are watching us, let us agree on at least 2 principles. If we cannot agree on at least these 2 principles, then there is no point in going any further, and well, unless that is you would like to become enlightened. So are you ready to open your mind? First principle, debt equals slavery. When you're indebted to something, when you're in debt, you are indebted to servitude until you have paid off your balance. Okay? 2, people, this is something very interesting to remember. Remember this concept because you're going to need to know this the entire time that we're discussing this issue. Principal plus interest is always greater than principal. I'm going to say it one more time. Principal plus interest is always greater than principal. Okay, now that we understand that, keep that in mind, please. The Federal Reserve Act was signed into law in 1913 by President Woodrow Wilson. It was originally drafted a few years earlier by a bunch of bankers such as J.P. Morgan, the Rothschilds, the Rockefellers on an island owned by J.P. Morgan called Jekyll Island. There's a great book that you should read. It's called The Creature from Jekyll Island. You'll learn all about it. Now, the Federal Reserve Act, this allowed the Federal Reserve to become the central bank of the United States. It must be noted, though, that the Federal Reserve is a private bank. It is as federal as Federal Express. So let's look at the diagram here and take a look at how this works. Anytime the government needs money, here's the government. This is the wonderful United States government here, okay? They call up the Federal Reserve, ring, ring, just kind of like my phone did shortly ago. And they call the Federal Reserve. All right, and they say, hey, we need some money. The Federal Reserve then creates the money out of thin air, like poof, just out of nowhere. And they loan the money to the government. So what happens? The Federal Reserve, they create the money out of thin air, and they send the money to the United States government. And we'll just say $1 billion. For some reason, why is it that anytime you think about that kind of money, you would say $1 billion? Yeah. So they send this to the U.S. government. What then happens is that the Federal Reserve then creates some money out of thin air and loans the money to the government and charges the government interest on the loan. So for this money, the U.S. government has to return back to the Federal Reserve one of those wonderful IOUs. Great chalk. You love that? Whoop, there we go. Okay, so therefore the government owes the Federal Reserve more money than what they borrowed. Remember, principal plus interest is always greater than principal. So where does the interest come from if all the money creation originates from the Federal Reserve? So if we can create the money and only this company can create the money, then if we owe them back the $1 billion plus interest, where does the money for the interest come from? It's a pretty good question, huh? Now, to illustrate this concept, let us pretend that only you and I and my daughter Emily here. Emily, do you want to come out and be on TV? Come here, sweetie. You can come out here with me. Come out and say hi to everybody. Uh-oh. Hey, sweetie. How are you? Oh, thank you. You want to turn on? Say hi to the cameras? Give me a shot. See, wave the camera. See what Daddy looks at? See that there? No? Okay. All right. Now, let's pretend that only you and I and Emily here, who's going to sit over here, and Emily's going to sit in this chair with us, okay? Let's pretend that only you and I and Emily. Are you paying attention? My prompter person is not helping me right now. There we go. Are the only three people in the entire world. You come to me and say that we need a currency to trade for goods between each other. So you need to be able to trade with Emily. Emily, wave to the camera, because they want to give you money. And Emily needs to be able to trade with me, and this whole thing works out, right? So we sit down and we come together, and I come up with a grand scheme to start the World Bank of Cristoni. Ha-ha. So me, you, and Emily pass a law that only allows me to create the money for our economy. Now, Emily here really doesn't want to be a leader. You don't really want to do anything, do you? Do you want to do anything? You don't know, you don't care? Emily here doesn't really want to be a leader, and she's just like, hey, just leave me alone. I'm going to sit here and play my dolls and do what I got to do with the economy, right? And I'm too busy running the World Bank of Cristoni. So we elect you to be our president. And so are you with me? So you call me up. Let's pretend we got this thing here. You call me up, ring, ring. President of the World Bank of Cristoni. Oh, what's that? You say that you need some currency in the economy to get things going. You want $20? Okay. So what happens is you call me up and you ask me for $20 to get your economy started. So I simply create the money and give it to you. It's like it comes out of a thin air, like poof, there it is. So here it is, and I come over and I simply create the money and give it to you. And what do? You give me an IOU agreeing to pay me back the $20 plus 10% interest. All right, now stop for just a second and think about it. Think about this. How are you going to pay me back the $20 plus the 10% interest of $2 if I create all the money? Where does this $2 come from? Emily, if you want to go back over there, you can, sweetie. Thank you very much. I appreciate your help. Where does it come from? You would be forced to ask me for more money, which I would have to create in order for you to pay the initial principal and interest on the first loan. However, in order for me to give you a second round of currency in order for you to meet your $2 obligation, I would require another IOU from you agreeing to pay the principal plus the interest on the second loan. Now, when someone borrows money from the bank, the initial amount of the money borrowed is called the principal. The bank charges an individual an interest rate for borrowing the money. That is, in essence, one of the ways in which a bank earns money. However, we must understand that interest is the creation of money from money. How does money create from itself? Let's take a look at this. How does this $20 create any more money? Can it have children? Does it mate? Does it pick a wife or a husband or anything? No. Interest is the creation of money from money, but money can't create money from itself. It's a mental thing. This method of money creation guarantees that we fight amongst ourselves, and it guarantees there will be failures. There will be foreclosures and repossessions and failed businesses. It forces one person to fight to take the principal amount from another in which they will be unable to return their principal and any interest. You must take principal from another person in order to meet your interest payment. Now, let me show you how this works for just a moment. Just like how the Federal Reserve loans money to the government and the government returns to the Fed an IOU to return the principal amount plus the interest. The same way works with the banks. The Fed issues money to the banks, woohoo, out here to these wonderful banks, which have you noticed they always have wonderful names like Integrity or First Community or let's say, all these wonderful names that sound so wonderful for you. But then what they do is they take the money from the Federal Reserve and then they issue this money out to we the people in the form of loans, okay? So all these people borrow money for different things, for buying houses, cars, business loans, small line credit loans, whatever the case may be. Now, if this is the only place that can create the money, okay, well, when these banks issue these loans to the people, they're only putting out a principal amount. Let's just say $100,000 between all these people, okay? $10,000, $50,000, $40,000, whatever, $100,000 between all these people. Well, they owe the bank interest. So how does this person who owes, let's say $10,000 plus, just for example, $1,000 in interest, if he can't create $1,000 in interest because only the Fed can create the money, how does he get his $1,000 in interest to pay back his principal plus interest? He has to take through the economy, somehow outsmart, outfox his fellow citizen down here to ensure that he takes some of the principal that they borrow. Let's say this person borrowed $10,000. So this person owes $10,000 plus $1,000. But in order for this person to pay back their $10,000 plus their interest, they have to take some of this guy's $10,000. So there's guaranteed to be a loser. Does that make any sense? Our system is guaranteed that we, the people, fight amongst each other. That we, the people, are like wolves eating each other. We want to make sure that I'm going to get mine by taking from you. That is the way our system is established, and that is wrong. That pits one American against another American. Do you see how the system is rigged to require a constant flow of continuous borrowing and the continuous mounting of debt? And debt is slavery. Borrowing and debt is the foundation of our economy. That is why the banks and the auto industry were considered too big to fail businesses. As a citizen, what are the two largest purchases you will make in your life? You are probably thinking right now that your house and your car. What about the next bubble of student loans? I just found out I have a son that's about to start college. Tuition just went up 3.5%. And tuition is becoming more and more expensive. You know why? That is the next bubble to pop that will need a rescue, and that is why the cost of tuition has risen through the roof. It is to ensure that borrowing continues and debt is continuously issued. Now, for those who refuse to borrow money, you're not safe either. Why does a run on the bank collapse the bank? It is because our system is set up on what is called a fractional reserve banking system. When you deposit money at the bank is required to only keep 10% of your deposit on reserve. The bank uses the rest of your money to issue loans to customers. The bank is earning interest from your money. You are only able to go and withdraw all of your funds at any given moment so long as everyone is not doing it at the same time, nor in a short period of time. When this happens, it's called a run on the bank, and it has nothing to do with a marathon. The FDIC insurance is there to protect you and your assets, but so what? If every single person went to withdraw their funds from every bank at the same time, guess what? The Fed would just print the money for you to make sure you get your money. But that would hyperinflate the currency, and your money would become worthless anyway. So, how does the fractional banking system rig the system for those who do not borrow money? Breaking the whole thing down into a simple ordered list, fractional reserve banking follows this pattern. The government issues bonds to the bank. The bank loans out 90% of the money. The borrower spends the money. The seller then deposits the money to the bank, and then the bank then lends out the money again, and the cycle continues over and over and over and over and over again. Step 1 kickstarts the system with the same way that you would kickstart a motorcycle. The government can always inject more money into the system, but every time it does, it starts this fractional reserve banking process over again with that money. Step 2 is where the magic of fractional, the magic, like poof, that magic money just appearing everywhere, of fractional reserve banking happens. The legal requirement to keep only a small portion of a deposit gives the bank the right to print money out of nothing. Now, step 5 is nothing more than running through steps 2 through 4 again and again for the entire cycle to start over. Now, this is the second magic of the fractional reserve banking because it creates a continuous loop for money to multiply itself. There's this person who's a million times smarter than me, and he's no longer alive, Aristotle, called the process of money multiplying itself the most unnatural. For see, money was intended to be used in exchange, but not to increase at interest. And this term interest, which means the birth of money from money, is applied to breeding of money because the offspring resembles the parent. Wherefore, of all modes of getting wealth, this is the most unnatural. And that's a quote from Aristotle. So in other words, they're trying to say that interest is like, if this $20 bill, where'd all the money go? Cam, did you come and get the money out of my pocket? It's like if this $20 bill sat there and said to this $20 bill, oh, you look so fine today. Yeah, let's go out on a date. Let's go to dinner. And they go to dinner and all of a sudden, oh, let's get married. Da-da-da-da-da-da-da. And they come together and all of a sudden, hey, we gave birth to a kid. There you go. Does that make any sense when it comes to money? I think not. So interest is the birth of money from money. That's a little weird, wasn't it? So if you can view the bank's keeping of a reserve as an independent step in the process, then the cycle looks like this. The people spend and deposit while the bank loans out the money, less the reserve requirement. Now the following graph illustrates the process of fractional reserve banking as described. Now let me show you how this works. Let me put this into a table so that you can visualize it differently. Okay? I want you to take a look at this for just a minute. This is the way the fractional reserve banking system works, and these loans I've calculated at a 10-year loan at 5%. Now listen, it's interest that can never be repaid because it's money debt owed, it's money owed that hasn't been created yet. Okay, so here's the way this works. Andrew deposits $1,000 to the bank. The bank is required to have a 10% reserve, so the bank holds back $100. But they loan out $900 to John, who spends the $900 with Chris, okay? So John owes the bank the $900 principal amount of the loan, and he owes the bank $246 in interest, okay? Remember what I said, principal plus interest is always greater than principal. $900 plus $246 is more than $900. Wow, aren't you glad we all went to second grade? Okay, so John spends the $900 to Chris. So then Chris comes down here and deposits the $900 into the bank. So the bank has to hold a 10% reserve of $90, and they loan out $810 to Mike. And Mike spends the $810 with Eric. Eric, aren't you happy over there that Mike over there spent $810 with you?
Oh, yeah.
What are you going to do with it?
Not sure yet.
Not sure yet? Well, I'm going to tell you what you're about to do with it, Eric. So Mike has a principal balance of $810 and owes another $220 in interest. Okay, so Eric is smart, and Eric decides not to spend the money, and he goes and deposits $810 in the bank. So the bank has to reserve $81, and they loan $729 to Kim, who spends it with Kevin. Now, if you're Kim, I know that Kim probably spent the $700, bought a Louis Vuitton purse from Kevin or something of that nature. So we got the $729 with $198.60 owed in interest. So Kevin, who sold Kim the Louis Vuitton purse, then takes the $729 and deposits to the bank. The bank reserves $72.90, and they loan out $656.10 to some random guy who doesn't work here named Jason, okay, who owes $179.10 in interest. So you see how this process goes, okay? So what has happened is there has been allegedly $3,439.90 of deposits created from an only real deposit of $1,000. Remember, this is only the real money, okay? The bank only has $343.90 in reserves for this amount. They've loaned out $3,095.10 to all these different people. And $844.50 is owed. Where does this money get created from? Out of thin air. It doesn't. All from $1,000. $1,000. You've got this money created out of thin air. You only have this much money backing it. This is the amount owed. This is here. What happens if since they only have this much in reserve, $343, what happens if all these wonderful people who borrowed this money just say, hey, you know what, I'm not going to pay the bank back. I'm not going to give them their money back. What happens when Andrew comes in and wants his $1,000 when, according to the diagram here, the bank only has this much money in there? Tell me that's not fraud. Look, yes, fractional reserve banking is a temporal pyramid scheme. The same basic structure as a Ponzi scheme. Temporally, it is fraud. It is fraud. It is fraudulent because the banks are lending out money that does not belong to them. When you deposit your money in a bank, you fully expect to be able, to withdraw the full amount at any time. You do not expect to have to wait for your money. However, this is exactly what happens when there is a run on the banks. En masse, people withdraw their money, but the bank doesn't have it because they have given that money away to someone else in the form of a loan. Banks then shut their doors and refuse to return people's money to them. What they typically do when this happens is they do what's called calling in a loan. If you have a loan on a car or a house, I don't know if you know this, but in all that wonderful fine print that you signed your name to that you probably didn't read, you authorize the bank. They can call in at any time and call in the loan, which means you have to pay the entire loan back immediately or you enter into foreclosure or repossession. Now, a run on the bank is exactly the same thing that happens in a pyramid scheme when the bottom falls out. The entire system collapses. Remember what I talked about when you pull the foundation out from underneath the building, it falls in? Guess what? The entire system collapses. They are not different in any significant way. Pyramid schemes collapse because there aren't enough people left to buy into the con. And fractional reserve banking collapses through a run on the banks because there isn't enough time to manage the con. This is the second way in which fractional reserve banking is criminal fraud. Listen, ladies and gentlemen, let's just be real honest. The system was rigged by bankers. It is much like going to Las Vegas. There is periodically a jackpot winner, but all in all, the house always wins. In this case, the house is the Federal Reserve, and we've been playing their game for the last 100 years. I think it's time that we quit doing the same thing over and over and over again and expecting a different result. I think it's time that we start trying to look for a better way of banking that's on the principle of sound money, backed by a commodity that doesn't require we the people to gouge at each other for survival. Thank you very much, and we'll see you next week.